The anti-US dollar trade is a very crowded trade. But the gold trade is surprisingly uncrowded. We have seen a real increase in the gold price, largely due to foreign central bank buying. The flow of retail funds into gold, as measured by the ETFs, didn't really start until 20 weeks ago. JP Morgan Chase said as recently as 6 months ago that the market share of precious metals and precious metals related securities is less than 0.5%, which is to suggest that gold occupies less than 0.5% of American portfolios. The 4-decade mean market share of precious metals is 2%. Should gold's market share revert to mean, that would suggest a 4-fold increase in interest. So while I take your point about the increase in the gold price, I would suggest to you that relative to other gold bull markets, we're in relatively early innings. I would further suggest to your listeners that they consider gold in the context of the prospects for the advancement of the US dollar. If they are happy with the level of debt and deficits in the United States, if they're happy with US governance, if they're happy with the prospect that the purchasing power of the US dollar might increase, or at least slow down less rapidly, then they should sell their gold. Unfortunately, for myself, I don't share those sentiments. I think that $130 trillion in off-balance sheet entitlement liabilities and $37 trillion in on-balance sheet liabilities, put into reference against a $5 trillion gross federal income, tells me that the only way out of our debt trap is to debase the US dollar. The consequence of that is that I see the dollar, quote, at least in US dollars, increasing. By the way, I don't think the US dollar will do badly relative to other currencies. I think they'll do badly too. I think that the US dollar will do badly in absolute terms. With regards to gold, my thesis is pretty simple. The U.S. government would have you believe that the deterioration in the purchasing power of the U.S. dollar is measured by the CPI, which I think I mentioned on your show in January as the CPI. It's not a cost of living index. When I measure the increase in the price of the basket of goods and services that I consume, granted, I'm a fat old cheapskate who doesn't buy much. It would appear to me that my purchasing power is declining at about 8% compounded. If you compare that with the yield on the U.S. 10-year Treasury, about 4.5%, that means that they're paying me 4.5% in a currency where the purchasing power is declining by 8%, which is to say that they're costing me 3.5% of my wealth every year for 10 years. That makes gold look pretty attractive. If I can hold my own, rather than losing 3.5% real compounded, that looks like a good alternative. And I think that's precisely what people are seeing. I'm old enough, Amber, to remember the early part of the decade of the 70s, the last time that the deterioration in the purchasing power of the U.S. dollar was greatly greater, than the yield on U.S. 10-year Treasuries, which is to say the last time that U.S. dollar savings really, truly didn't work. And that ushered off the greatest gold bull market of my career. The better news than the 1970s is the incredible advancement of technology, the ability to affect economic growth with less capital than we used to. A second bullish phenomenon is that the world is much more global. The world, in many senses, when I was a young man, was the U.S., the U.S., the U.S., and the U.S. And that would be dangerous. It's worthy to note, and I'll return to the bull case for the U.S. dollar and U.S. economy in a minute. But it's worthy to note that at the beginning of the decade of the 70s, gross federal debt to GDP was about 35%. Now it's 120%. There's less string than there was at the beginning of the decade of the 70s. The other bullish factor, frankly, is the inclusion of a whole bunch of people in the workforce. I dare say in 1970, Amber, that you wouldn't have been the host of a podcast It would have been some old, fat, bald, white guy like me. And that's a very good thing, except for perhaps for some old, fat, bald, white guys who can't compete. But the fact is, there's a whole bunch of good news in the economy. The bad news, however, is that government size of GDP in every country has grown. Debt and deficits have grown. The baby boomers who drove the economy for 40 years are taking from it now. Demographics are lousy. And so, in that consequence, things are both better and worse than they were in 1970 at the start of that market. But on balance, I think they're markedly similar. In the United States, we fought the war in Vietnam, which we lost. We fought the war on poverty, which we lost. And we were left to pay the bill. We didn't have enough money, so we inflated away the net present value of the obligations. The same circumstance that we're facing today. For many buyers, well, let me rephrase that. For many of the few buyers who are in the gold space, there is some risk on. There is a whole group of speculators who think the fact that the gold price has gone from 2,200 to 3,700 is good. An old school guy like me thinks that the price of something being 50% higher means it's 50% worse. I don't want to take the bait about technology valuations because, as you suggest, I stay in my own lane. I don't know how to spell or pronounce NVIDIA, never mind analyze it. So describing it or Microsoft as the rest of those or the rest of those things as expensive or cheap isn't something that I can do. The U.S. budget, or for that matter, the Canadian federal budget, if you all ever have one, I'm much better placed to comment on. Those are big numbers that don't involve much technology. I'm cognizant of the fact that market breadth in the broad market is terrifyingly narrow. The gains in the S&P 500 are basically a function of 7 or 8 large cap technology stocks. The consequence of that is that I can't say whether the S&P 500 is overvalued or not, given that so much of the concentration is in names I don't understand. I can say that the broad economy would seem to be faltering. Certainly, I see that in my country. I see reasonably strong jobs growth, but I see the jobs growth being sort of a barbell, which is to say enormous labor shortages in highly skilled occupations and lots of job formation in service industries that don't pay living wages. And real stagnation in the middle, which is, I think, problematic. I'm not an economist, but it would appear to me that some of the economic growth that we hope to get from the increased efficiency due to technology will begin to be constrained because of an incredible and partially, by the way, deliberately implemented constriction on labor. As an example, in my country, the cessation of the HB1 visa, which is one of the dumbest decisions I've ever heard of out of government. And at the same time, the jobs growth in jobs that can't sustain a living wage. I think the economy, at least in my country, is somewhat weaker than is broadly imagined. Let me explain that to you. No, I'm not going to give you a price target. I'm old enough not to fall for that bait. But let me tell you this. In the decade of the 1970s, the U.S. dollar lost, according to the Congressional Budget Office, 75% of its purchasing power over 10 years. During that same period, the gold price ran 30-fold. Now, I'm not suggesting to you that the gold price is going to run 30-fold, having already run 12-fold since the year 2000. But I am suggesting that the U.S. dollar will again, in the next 10 years, lose 75% of its purchasing power. Really bullish. I would suspect that it is likely that in real terms, the gold price stays constant, which would suggest in nominal terms that its rise mirrors the decline in the U.S. dollar. Ergo, a 75% decline in the purchasing power of the U.S. dollar over 10 years should likely result in a nominal gold price increase that is 3- or 4-fold over 10 years. I need to say, I own gold as a store of wealth. I actually save in gold. I maintain liquidity in dollars. Silver's different. Uh, Silver's a speculation. My experience has been that sort of midway through a precious metals bull market, when the generalist investor is attracted to gold's momentum and the precious metals narrative, and he or she comes down into the precious metals space, silver tends to outperform gold. And silver's performance in the last 3 weeks would suggest that we may be at that moment. The trader in me, which is a small part of who I am, tells me that silver may actually break out in October. If it doesn't, I think it's a matter of time. I remember well prior bull markets where I was attracted to the gold move and I was astounded by the silver move. And I expect that past is prologue. The asset class that has likely the most upside is that very, very, very small club of high quality silver equities. The combined market cap, and I'm not talking about all the little nothing nowhere silver companies that don't happen to have any silver. They're just looking for it. I'm talking about the ones that actually had some silver. Their combined market caps aren't large enough to handle the amount of capital that's going to come into them. I remember very well as a young man in the decade of the 70s, the shares of one penny dreadful, Coeur d'Alene, went from 10 cents to $65 in 10 years. Sadly, I was too inexperienced and too poor to take advantage of it. But the next silver bull market, we financed Pan American at 50 cents and Silver Standard at 72 cents, both of which 5 or 6 years later were $40 stocks. The upside in these things, when the stars align, is insane, truly insane.